With estimates showing $6 billion going to workers and $171 billion going to shareholders, some wonder if stock buybacks are really the best use of profits. So with us now is Nick Colas, DataTrek Research co-founder, and Bill Lazonick, UMass Lowell professor of economics. Bill, I want to start with you because you did a recent analysis of where corporate America is putting its tax savings, and you found that the vast majority of it is going to buybacks. Explain.
Okay, well, it's nothing new. This has been going on since the mid-1980s. Companies have been prioritizing distributions to shareholders, and in 1997, buybacks as a mode of distribution to shareholders surpassed dividends. And for the decade 2007-2016, S&P 500 companies spent $4 trillion on buybacks, $3.9 trillion on dividends. That totaled about 94% of their net income. So they're not investing in the companies. And investing in the companies is not just investing in capital equipment. It's not just investing in R&D. It's investing in people. It's investing in people who get higher wages over time as they help to create value, those innovative products. And that's what's not happening. And that's why we see, it's a prime reason why we see a concentration of income among the richest households. It's going on and getting worse over time, and the disappearance of middle-class jobs. It's buybacks have a lot of blame to bear for that.
And certainly you make some good points, Bill. But Nick, isn't it really not an either-or scenario? And here's what I mean by that. You got a lot of workers at a lot of companies that have 401ks. They also have stock, purchase plans for their own company's stock. You have teachers, first responders who have pensions. When you see stock buybacks and that gives some lift to the equity market, isn't it good for all of those middle-class and working Americans as well?
It is, and I'll tell you, whenever you walk into a public company anywhere in this country, the first thing you see on a bulletin board is the stock price. And it informs a lot of corporate decision making as well. When stock prices are rising, labor markets tend to improve. CEOs and boards have a little more confidence to expand. And so it isn't just a matter of what wages are, what is the cyclicality of those wages, what's the cyclicality of employment, and a rising market does tend to provide a signal to corporate boards that it's okay to hire, it's okay to pay a little bit more. So it isn't just as simple as saying buybacks are good or bad. The stock market and labor markets also inform what those two things do.
But Bill, there's no question that when the stock price goes up, that's much better for the CEO and the other C-level executives than it is for the frontline worker. So my question is, we've seen the charts that show that wage growth for the middle class has been pretty much flat since the 80s. What changes that? What market forces there going to be that actually changes the equation so that workers get the benefit when there's something like corporate tax cut?
Okay, well, first of all, there's a big difference between dividends and buybacks. So dividends, you get money for holding shares. And if you hold the shares, you want the company to reinvest in its workforce, to reinvest in its products. So when you sell the shares, hopefully, if it's well managed, and that's the important thing, the company stock price will be higher. Buybacks incentivize gains from buying and selling shares. And the main beneficiaries of buybacks are people who are in the business of buying and selling shares, including investment banks, hedge fund managers, but also corporate executives, the way stock compensation, stock buybacks, and stock awards are structured, and I've written a lot on this, are structured so that when you get this boost with the open market repurchases, the stock price goes up, they can cash in. And the fact is that it's not public information when companies are actually doing the buybacks, which is when you're getting the boost to the stock price.
It's interesting. Goldman had a note yesterday, Nick, where they said that the correction coincided with the blackout, the buyback blackout, and that corporations are now the largest source of demand for equities.
No, it's absolutely true. Look, the biggest problem with buybacks from a market perspective is they're very pro-cyclical. Companies do buybacks when they have money, when the cycle is peaking, when they have a lot of free cash flow, and they tend to buy back at the top. At the bottom, when they don't have the cash or the cash flow and the stock is much cheaper, they don't have the cash to buy back. So it does have an exacerbating effect over time.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.